Okay, next. We're moving into our venture capital angel investor deal maker panel, so don't go anywhere because we have 6 great experts coming up here on stage. And they are Jenny Lee, managing partner of GGV Capital. I know I saw it there, she is. Melissa Guzy, managing partner, Arbor Ventures. Tina Zhu, founding and managing partner, Kleiner, Perkins, China, and also TDF. Tytus Michalski, and you thought this was an all-women panel? No, it's not. Tytus Michalski, managing director, Fresco Capital. And finally, from Silver Lake. Where is our Silver? Oh, there he is. Okay, he was hiding in the front row on me. Zheng Wang, thank you very much. Okay, and he's going to help you get mic'd up here because we got a full house. Does everybody have a mic? Is everybody okay? Yeah, I think we're okay. Maybe I get to sit down. So this week we've had all these events for Start Me Up Hong Kong and Hong Kong startups, and it's just been nonstop, right? Everybody must be exhausted by now by events. But anyhow, what do you think about, is this going to really, is this kind of buzz around Hong Kong startups? Do you really think this is going to take hold? And what is it going to take for Hong Kong to have a superstar entrepreneur?
I'll jump in. I think it's good to have events, and it's great to build up buzz and momentum, but ultimately we know that to build a startup ecosystem, you need companies, and that's a marathon, not a sprint. And so to build large, valuable companies is going to take years and maybe even decades. And we have to be realistic and practical about how old the Hong Kong startup ecosystem is. It's about 4 or 5 years old, so it's going to take a few more years, if not much longer.
So it took Silicon Valley a couple of decades. Is it going to take Hong Kong a couple of decades?
We like to move faster, but it's hard to speed things up if you're going from 60 years, it's hard to turn that into 10 years. So it's going to take some time. Yeah,
we're in the era of the lean and fast startup now. The pace is so fast. And do you think we might see one even in the next 2 or 3 years? Anybody? And if
I don't think so, Rebecca.
Okay, Melissa doesn't think so. No. Okay.
I mean, we've been investing in Hong Kong just like Tytus for a number of years, and the community is still rather immature, and it needs time, and it needs to figure out what its identity is, because being the small sister or brother to China is not going to work. If you want to invest in China, you should be in China. So I think Hong Kong needs to find its identity, needs to find its stride before we're going to see a truly successful company here. I think we're starting to see the beginning of it, but it's going to take time.
Maybe I'll just add something. I think Simon is a perfect example of what a Hong Kong entrepreneur should do. Hello, Simon. We had a call, never met up. I think that if you're an entrepreneur in Hong Kong, you should not be thinking just about the Hong Kong market. Why, live this huge market in China? If you're thinking about P2P market, if you're thinking about mobile market, you have 500 million smartphone users in China, an hour away from here. So I think as you think about what it takes to be a good company, it's not just to be a good Hong Kong company. It's what it takes to be a good global company. And being perfectly in Hong Kong next to China, I think you have the greatest market next door. So that's how I see.
That's an interesting perspective, because as so many of the ideas and concepts have been very focused on Hong Kong, and here we have this panel of people from Shanghai and other parts of the world, and so I think we're getting a more well-rounded picture here of what the reality is and what the challenges are. And what do you think is the number one challenge for Hong Kong as a startup and innovation capital? What is the number one challenge? Can it surpass Beijing at all, or Shanghai? We have Tina. You've been investing from Shanghai and in China for
15 years.
15 years. Okay.
I would say probably the biggest challenge would be getting the right type of talents and attracting all kinds of different talents to Hong Kong. I mean, Hong Kong is a beautiful place to live, but it's not the cheapest. So finding affordable professionals and talents to help entrepreneurs to build a world-class company in the long run, I think probably requires some creativity. Following on what Jenny says, maybe the team, the founding team will be based in Hong Kong, but you probably need to leverage other teams. And since you're going to focus on geographies across the neighborhood, so having the ability to build a global team, I think is key.
Okay. And from a private equity standpoint, what do you?
Yeah, I think just from a cultural perspective, you do need events like this to foster and create an entrepreneurial culture. Comparing Hong Kong to Silicon Valley or Beijing, Shanghai, it's still a different feeling. As we have more of these events, it's going to get much more similar. But I think that kind of culture will attract investors and entrepreneurs and create a very positive feedback loop. But that will take some time. And I do echo Jenny's point. The market has to be really big for people to have big ideas, for investors to get very excited. So you really should not just be focusing on one city.
We have a couple of investors here on the panel who were early, very early in Alibaba. And what were the lessons learned from, how do you get into an Alibaba, and is there another Alibaba in the works somewhere? Jenny from GGV Capital?
We'll let Tina start off first.
Yeah.
And then I'll address
Okay.
where's the next Alibaba.
Okay.
Okay, yeah, so we were the Series A investor in Alibaba. We got in, I should say TDF, not Kleiner Perkins. TDF got into Alibaba February or January 2000. Once we got into the investment, I think we were not sure if the investment will ever pan out, because from 2000 to 2003, it was the most difficult time for the company. I think we had a cash burn rate to last less than 6 months. So every board meeting was really talking about how to survive, how to cut costs. Finally, end of 2000 or beginning 2001, we were very fortunate to recruit the former COO, Savio Kwong, to come in, who was a GE president of their medical division. So I would say, when I served on the board with, at that time, with Fidelity and Goldman Sachs and SoftBank, it was very much a struggle. It was all about startup. It's not the shining stories that you hear today. It was all about survival. And I think it was because that tough time, that first 3-4 years that the company went through, the management team really solidified and really know how to weather different times and really know how to identify big market opportunities. I would say, all the credit to Jack Ma that he has ability to recruit the best talents. He is someone who has a spiritual leader, but I don't want to repeat the story. I would just have to emphasize that Alibaba went through the same super tough times. I remember one of the board meeting was a presentation by the management team that if Alibaba were not able to survive, how are we going to liquidate? So so that I think that kind of memory is unthinkable today, given the success.
Sure. Jenny, anything to add to?
Yeah, I think that as investors, and I believe entrepreneurs and investors here in the forum as well, we are looking for the next Alibaba, right? I think the story around Alibaba, the hardship, is not atypical of what a entrepreneur has to go through to build a company 10 years ago, 14 years ago into today, 250 billion company. Of course, not everyone makes it to 250 billion. I think most investors will be happy if you get to 10, given where we come in. So I think that it's a lot of lessons learned around, how Alibaba, I think one of the biggest learnings that entrepreneurs, talk about when they think about Alibaba is how Alibaba has been very successful to cultivate a culture. I think the Alibaba culture is well known, how Jack has managed to attract a team of founders with him who's been with him through the ups and downs of the cycle. A lot of them still with him today. What does it mean to be the Alibaba culture, where you could start off as a front door guards person with no education and yet be able to rise up to be, say, the CEO of the Taobao division. So, as companies think about, entrepreneurs thinks about how do you build a long-lasting company. It's not just about the business model, the market that you're targeting, but it's also about what does it mean from a cultural perspective that you can continue to attract talent and, retain this talent as well. So I think there are a lot of learnings from big companies that we should continue to look at when we think about the leaders of 5 years ago, the leaders of 10 years ago. But as investors, we are looking for where are the leaders 5 years from now, 10 years from now. And I think that we are ecstatic. I think as investors in this era, we are looking at the next 10 years. And the next 10 years is about how the mobile internet is going to disrupt industries. From convergence between US and China, from convergence, what mobile means, disrupting traditional, we call it online services, O2O services, or on-demand services. Shared economy is disrupting traditional industries like education, finance, auto, travel, the likes. When you think about mobile, we think about mobile convergence, hardware, software, data convergence. I think the Handy CEO is trying to capture that market as well, right? What does it mean to have content services all at your fingertips wherever you are? So there's a lot that's going on there. And I think that those are blank new areas where the Alibaba, Tencent, or even Baidu cannot claim to be number one. So it's a battle, but it's a battle where anyone actually has a chance. So, that's where we are excited. That's where I'm excited in terms of looking at, the cool trends, the cool products and the devices that entrepreneurs are building today.
So you said you're actually looking for the next Alibaba. And so I was thinking about that you're an investor in the Chinese smartphone maker Xiaomi. So is that going to be an Alibaba? Is that going to go public?
Right. So I think Xiaomi is a very interesting case study as well. I think what Xiaomi has shown, the innovation around Xiaomi is about what it means to disrupt the supply chain. So leveraging the huge supply chain that China has to bring basically pricing order in the market. That's how I call it, where you can now get affordable product direct from the manufacturer, disrupting the entire distribution and channel that goes direct. And then the second part that what Xiaomi has done is basically allowing it's a fan-based economy, right? It's about the Xiaomi fans, where you could now, as part of consuming that hardware is an entryway into your phone, your daily life. The Xiaomi TV, the Xiaomi router, the Wi-Fi router, it's an entryway into your home. So I think they are very interesting company. I think Lei Jun has done a fantastic job in terms of basically disrupting the business model in what we think of as a traditional phone company. So can it get to where Alibaba is today? I think Lei Jun definitely has that ambition. If you think about mobile internet and whether that can be as large as a traditional PC internet, then I think we are at least 3 to 5 times bigger. So very hopeful.
Yeah, I do want to make a quick comment on Alibaba. We invested 10 years after Tina invested in Alibaba.
And made much more money.
And amazingly, at the time, the company was still having a lot of difficulties. I mean, it's very hard to imagine now, but even in 2010, 2011, the company was going through the B2B transition. As people may recall, the Hong Kong listed company growth was slowing down. There's some management reshuffling there. Obviously, the now famous Alipay incident. There are a whole bunch of issues that at that time was somewhat concerning for any investor. But I kind of want to use this example to show you that for a company to go through all the difficulties and challenges, having a unique culture, a coherent team over all these years. I think Alibaba's team attrition is extremely low by any standard. Is very, very important. And to make final comment on how to become the next Alibaba, I think picking the orange color is a pretty good way to start.
Yeah, the orange color is a good start. Okay, I like that. So if you're looking for the next Alibaba, what's your secret about how you're looking for that next Alibaba? How do you go about finding that hidden gem out there? Melissa?
I think for us, I mean, we're looking at disruption in the financial services market throughout Asia. So for us, it's not about looking for the next Alibaba, it's looking for the next billion or multi-billion-dollar opportunity. And that's how we think about it, because there's Alibaba, there's Tesla, there's lots of winners in the world. And I don't think you can never replicate something exactly the same way again. So for us, it's about finding the right management teams, the guys who actually are driven to work till 2, 3 o'clock in the morning, who understand how to build a team, how to motivate a team. As you said, even 10 years later, companies never stop going through those growing challenges. But it's the guys who won't stop until they build a multi-billion-dollar company that is truly the differentiator.
Give us a sense of what it's like to try to find these, great entrepreneurs to invest in, or are they just knocking on your door so much that you don't have to go out and look for them?
Well, I think we probably all have similar ratios of, hundreds of deals till you find the one you want to do every year. Most partners do 1 or 2 deals in most firms per year. That's it. So you go through a couple hundred deals to find the right founder.
And how much road mileage is involved with that?
Well, I've been known to support Cathay Pacific and probably ruin the carbon economic equation. So I log about 200,000 miles a year on Cathay right now, traveling through Asia and wherever.
Wow.
I'm sure everybody here is pretty similar in that sense that that's what we do, right? You're seeking out the best entrepreneurs wherever you can.
Yeah, I think, Rebecca, in terms of the commonality from seed stage all the way to Alibaba at IPO is the quality of the management team. And depending on what kind of filters you use, it can be a little bit different. But people that are on a mission to change the world, generally that's a good start. So if an entrepreneur comes in with a pitch that says, I'm going to IPO in 2 years, that's not a good sign, because they're thinking too much about financial issues and not about how they're going to change the world and really make an impact. So for us, certainly, we end up investing in a lot of mission-driven entrepreneurs who are focused on, here's how we're going to change, for example, education or the environment or healthcare, and that's really exciting.
You're investing quite a bit now in Silicon Valley. How are you getting into these deals?
Yeah, so it's fascinating that even though technology has been around for a while in Silicon Valley, globalization hasn't been as popular among a lot of the investors, people on this panel being an exception. And so what we found at the seed stage in particular is there's a real gap with people who bring a global perspective. So it's not necessarily that every company has to think global from day one, but the companies appreciate that opportunity because they know that the marketplace for talent, the marketplace for customers is global. And so the fact that they have us as investors, even at the seed stage, is a very valuable asset. And of course, yes, as investors, we have to still compete with other investors and be able to add value. And so,
But when you get off the plane in San Francisco, do you have your agenda already set, every entrepreneur you're going to see, or is there a surprise factor involved at all?
both. So we have our agenda, but we always leave time for serendipity, and weekends are great for that. In Silicon Valley, people don't stop working on the weekends, so usually if you leave that extra buffer time there, then we have those last-minute meetings, and we've literally been in that position where we were introduced to a founder on a Thursday evening, met with the founder on the Friday, and ended up investing the next week. And so that has happened to us.
So are we at the stage, we're kind of in a bubble economy again now, are we at the stage where, I covered the Sand Hill Road and the dot-com bubble, and back then people were writing business plans on the back of napkins and getting funded, in Palo Alto coffee shops. Is that kind of stuff going on now?
What we're seeing is that capital raising is not easy. And I think people that read the press articles think that raising money is easy, and everyone looks at the success stories. But if anything, you hear the opposite complaint from most entrepreneurs, that it's still really, really hard versus what they expected. And so in general, I think that's a healthy phenomenon where raising money shouldn't be easy, because that's also an introduction to the rest of building a startup. As we know, hiring talent is not easy. Getting customers is not easy. So it is a great test for entrepreneurs that if you can't raise capital from investors, then how are you going to build a business? And so no, I don't think it's like 1999 where people were throwing funny money around.
But I do think there is money in the market. So I don't know about everyone else on the panel, but we have actually having to work really, really hard for those seasoned entrepreneurs who actually can raise 2 or 3 times the amount they're raising right now. And it's not about the money, it's about what value you're going to bring to them. And so even during the term sheet phase of having to show them value of what you can do for them, I would say, it's pretty extraordinary how hard we're working on certain deals with very seasoned entrepreneurs.
And I would probably add that the phenomena in Asia is a little bit different. I do think there is a bubble, particularly in Greater China, because nowadays you will walk into a meeting and they're pitching you to do a pre-A funding, which all the VC now are moving downward to justify their deal flow. Everyone's doing, before everyone says they only do A and B, now it's pre-A, some even thinking about doing seed. So I think there are thousands, literally thousands of companies that have successfully raised seed capital this year. Then I think the balance of the equation is going to tilt very soon because it's very easy to raise seed capital, pre-A capital, at least to date. Very soon we think that when you have 10,000 companies competing for Series A, Series B, then I think that equation will change and tilt. But for now, it's very easy to raise capital. 5 minutes, someone will say, okay, I'll wire the money to your bank account within 5 days or tomorrow.
So is due diligence then suffering? They're just not doing the due diligence. I can't get the words out. You know what I mean, though.
Very much so. Now
Yeah,
I think a lot
okay.
of investors are investing based on instinct.
Yeah.
And the reason you have to, and everyone says speed is of the essence. Personally, I'm not quite sure it really is. But at the end of the day, it just means more and more companies that should not get funded got funded, and irrational competition began to take place. And capital funding, will be less efficient. But I think the reason people compete on speed is because if you tell the CEO that I want to do due diligence, CEO say, okay, no problem, thank you, and then sign the check with the next meeting.
Well, that's kind of sad, actually. Do other people see the same phenomenon?
Yeah, I think that on the very early stage entrepreneur, that's indeed the case, because there's really not a lot to due diligence, right? It's about, hey, I have this great idea, I'm going to bring pedicure to your home. On-demand services, right? And so, it's all about execution. It's whether he can find the right team to do it. The business plan itself is not extremely disruptive. It's actually an evolutionary type of a change. So in those categories, definitely I think it's the team. So when you're making that, you call it a bet, you're actually making the bet and the judgment call on the team. As we look at, kind of the next 5 to 10 years, we look at 2 types of business model. The bring pedicure to your home or home delivery to your home, those are what we call evolutionary model. In an evolution business model where you are indeed disrupting the traditional vertical, the key essence there, though, it's about, as I mentioned, execution, capital helps. So the ability to basically attract, venture capital to give you $100 million for delivering food to your home, that helps. So market leadership, being first there, being first to have capital actually helps in those business model. And I think that's where you see VCs, even PE guys. We've had a bunch of calls from our friendly PE investors who's turning their eye from traditional tech to internet. And that's where a lot of capital is funneling to right now with valuation that can triple, go up 5x in 3 months. Then we have the other type, which is what I call disruptive model, right? The Tesla of the world, the Xiaomi of the world, the Internet of Things. That category, in my mind, is disruptive. You're talking about drones, you're talking about artificial intelligence. There is a lot more technology behind it. There's a lot more kind of breaking the mold. There may not have been a product in the market. You need to have the right product team, software team, services, data analytics. So in those businesses, I do believe that you will get great outcomes. But obviously the odds are, and so there will be time to do due diligence. I think those are not easy sectors for VCs to just jump in and put in the 2 million because it will require maybe a 10 million check, initially another 20 million check, especially if they are hardware, and they need working capital. So we are seeing, different trends definitely depending on which vertical they are in. And then on the other side, we have our very unfortunate companies that focus on services to enterprise. So in the US, SaaS is hot, right? Software as a service, you have a Workday that goes out 9 billion market cap in IPO. But in China, the enterprise sector has not taken off. It's a harder sector to go. It's still relatively new behind the US, I would say 5 years behind. And that sector, you could do 3 months due diligence. And valuation is great. And I think it's a sign of the market. The market is not quite there, so companies in those space, entrepreneurs in those space would have to be a bit more patient, a bit more efficient with the capital that they have, and find investors that can actually help them to think through execution on the sales front. How do you get your product into the hands of enterprise? So really 3 types of areas that we are seeing. I think as any VCs, we have to pick our spot. You can't do everything. You can't fight with all the great guys here in the room. So pick your own fight.
So is Silver Lake competing for these kind of deals too?
Well,
These
no,
kind of
well,
red-hot
I don't
tech
think we're
deals?
competitors. We work with each other, playing different roles in the
Yeah.
ecosystem. Just as a 10-second introduction, we're not a VC firm. We actually back much larger scale companies at much later stage. But that being said, we clearly want to be very actively involved in the ecosystem because you have all these shooting stars that took a few years to get to 10 billion US dollar revenue and profitable very quickly. So we don't want to miss those opportunities, and sometimes you still miss those opportunities. So that being said, I do agree that it's a very good time to be an entrepreneur from A, B, C, D, E rounds. My piece of advice is that you as the entrepreneur, clearly it's a great time for you, but you do want to make sure that you pick the right investors. The people who write you a check tomorrow, under some circumstances could be ideal, but if you want to build a large, sustainable, long-term business, the quality of investors doesn't matter a lot. If you're focused on doing something very short-term, then just get the money and run. But so I think that picking the right investors is important. The way they discuss business with you, the way they approach due diligence, how thoughtful they are, doesn't matter in the long term.
How does Silver Lake select its opportunities?
Yeah,
how much of it is the technology versus the financial aspect of it?
Yeah, we are a bit different. I mean, we are, I would say, somewhat contrarian in many ways. Take the Dell, take private as an example. I don't think anyone a year ago was thinking about trying to invest in Dell when people think PCs is going to die. We focus more on sort of the hidden gem, the deep value type of opportunities. That being said, in Asia, the situations are a bit different. You won't find a lot of Dell type businesses in Asia. So again, we adapt to local conditions. In Asia, the challenge is to try to catch the shooting star at the right time, which is not easy. But overall, I think we are typically the ones, hopefully not 10 years after you guys, but maybe a couple years.
Okay. On this panel, we have several who have raised funds recently or are raising new funds, and I'd like to ask the panelists, how are you going to invest all this money now? We're in this bubble economy, valuations are really high. You got all this money, all this capital to invest. So what's going to be your strategy going forward in this kind of climate?
So we'll start first.
I know, Gigi, we just raised
Yeah, that's
a
right.
new fund this year, right?
That's right. So we just raised a 625 million US dollar fund and a 700 million RMB fund as well in the second quarter of this year.
But that's a lot of money.
It's actually not enough in this market.
Not
Where we
Okay.
have PE funds who have a couple of billions. So I think for us the strategy has not changed. Right? It's for GGV. A few key things about us. We are cross-border investors. We do look at both US and China, but from the same fund. And that's one. And we've done that for the last 14 years. Next year will be our 15-year anniversary. Number two, we are sector experts. So how do you compete? How do you compete with the guys who is out there writing a term sheet after one meeting? I think the way to compete there is by being better. So expertise. What we want to do is to attract entrepreneurs who actually value this expertise. If they only value speed, that's not what we're competing on. But if they value the fact that we may know travel the best, or we know gaming well, or we know the commerce, right, cross-border commerce. If you are a company sitting in China trying to figure out how to sell to the US, we're the right guys for you. So our partners are focused by sectors. We have 14 years of experience. We have brought many companies public. In the last 12 months alone, 15 of our portfolio companies has raised more than $1 billion from the market. So our entrepreneurs are better than us. They raise more capital. And so, being part of that,
Yeah, but
hopefully
how are you going to invest this capital? I think I've noted that GGV Capital started off as an early stage venture capital investor, then you moved to a later stage.
we
Now
the
you're
reverse.
doing
Reverse.
more.
The reverse.
Now you're doing more of the early stage.
So we
right?
started as an expansion stage. We are typically in Series B and C. And over the last couple of years, we are moving earlier to Series A in those sectors.
Why is that?
Well, I think one, we do have the expertise that's being built. We feel that in China now, the talent pool has matured to a level where even when you come in at Series A, you are investing in qualified entrepreneurs, people who are able to build a team quickly. Whereas 10 years ago, all the entrepreneurs you meet in China, they are first-time entrepreneurs. And so they're all fighting against each other, give them 2-3 years to grow. It's better to come in at the Series B stage. And so by expertise, we have also highlighted certain areas. Internet of Things is one of the big areas for us. We have made now 7 investments in the last year, both in the US and China. Online demand services, again, is a big area for us. And then cross-border commerce is the third vertical for us.
Okay. Melissa,
We just got finished raising our first fund for Arbor, so we're all pretty, thank you. Long journey, just like an entrepreneur would have. For us, we're in financial services across APAC. So everything from Japan down to Australia. So we have the ability to move across the region as valuations are changing and we see different opportunities. I think in fintech, it's a little bit different. In China, internet finance, the valuations over the last 18, 24 months have gone fairly crazy, pretty much at 11, 12 times where they were just a year ago. And therefore, what we've seen is we were able to get into Japan quite early, and we're just starting to see the significant markups in the Japanese market. We were able to get into Southeast Asia also quite early. We're starting to see that market also, valuations are getting quite high. And now we're actually doing an investment in New Zealand and Australia where there's a lack of venture capital money and we haven't seen the valuations go that high. So we're just picking our spots. Like most people on this panel, I was around in 2001 in the venture community. So you have to really look at companies in a more normalized period as far as valuations. And the question is, do you love that company enough to be in it for 8 to 10 years? And do you love it at that valuation? And so we just take that approach to it. But at the end of the day, you find those right opportunities and you invest. But as I think everyone has said, you really want entrepreneurs who value what you can add and not just writing a check at whatever valuation.
okay. Yeah, I'm hearing a lot about sector experience here. And Tina, you've been behind so many of the huge success stories from China. What are you looking at today?
So I would say our position is more, we like to find potential dominant market leaders in a huge market space. I know that sounds like a very general statement, but we do look very hard. Every time we try to make an investment, at least in the old days, we want to scout out all the competitors, like dozens of them. Then we choose one, because our policies, we do not invest in competing companies. Once we bet on one, we will, basically support them throughout their entire company building process. I would say for us, similar to Melissa, fintech is a huge sector. We actually are an investor both in Lending Club in the US as well as in China, the Lending Club equivalent in China called Credit Ease, except Credit Ease is 2.5 times the scale of Lending Club in US. So it's another company that when we made an investment, it was less than couple million of revenue. This year, I think the revenue will be close to, it will be north of $1 billion for sure. It's net revenue, and the loan extent is over, I think, 50 billion, so US dollars. So it is a company that's, again, growing by leaps and bounds, I think, since our investment over 100 times. So so that's the kind of business we're looking for, is companies that are really scalable, but that doesn't mean we're so lucky that every company we invest within 3-4 years they grew by 100 times. But we look for companies with that kind of potential. That's one type. The other type we look at is we really believe in the so-called the world is changing to last minute, I should say last second economy. If you think about the Uber, or in China, there are a lot of on-demand for services for, if you think about the daily life, clothing, transportation, food, 衣食住行, and then housing. Okay, so basically, if you think about each one that's category, that touches upon your daily life. If you can have real-time services at your fingertips, without going through, the normal reservations and things like that, that will hopefully be a very scalable business opportunity. The hard part is finding companies and business models where there's actually barrier to entries because they're such easy business models that a lot of people can replicate and you can find competitors everywhere. So that's the challenge. But we like to think that we're able to find, quality management teams who are first mover, just like when we invest in CreditEase. Right after our investment, I think now there are 2,000 companies that are look-alike, but still, we are fortunate.
2,000?
2,000 peer-to-peer lending business in China today. Yeah, but we think 90% of them will go out of business within 2 years. Yeah. So that's a kind of cutthroat competitive environment that you're looking at. With every business model you decide to go into with huge market opportunities.
Are you investing exclusively in China?
We invest in China, Hong Kong, Taiwan. We have a couple investments in Taiwan, one of which is already public.
Mm-hmm.
So the other area that we don't talk about anymore because it seems like a bad term is green tech. We actually have done reasonably well on China side. I don't know about the rest of the world, but China side, we invest in a market leader in the electric vehicle battery management system company called Sino EV. We just got a huge order, after 6 years in the going through the winter because no one wants to invest in EV. So that's one area you can spend 6 months of due diligence and won't lose the deal. But it's changing now because electric vehicle is the next hot concept. We believe by end of next year, every single car manufacturer, major brands in China, will have their own EV, pure EV, coming out. And we think 2016 is an inflection point of consumers buying EV. But in any case, so the company why we invested is they focus on battery management system, which is the most capital efficient part of the ecosystem. It's a company that the founder, actually Chinese American, came out of Tesla. He was a chief design engineer for Tesla. He decided that Tesla is for the super rich or the wealthy, and Chinese people needs economic model of the Tesla. So we actually compete to a certain extent with BYD, but we actually are designing into 3 of the top 5 EV manufacturers. But so my point is we're looking for emerging dominant market leader in a space that has huge potential that touches every part of your life.
Interesting. Well put. Yes, Tytus?
Yeah, I think so. One difference at the seed stage for us, a big filter is capital efficiency, right? Where we're companies that are raising between $500,000 to $3 million over time, and so how much can you get done with that amount of capital? And one big difference between 1999 and these days is both on software and hardware, you're seeing huge productivity improvements. So one of our more aggressive companies called Spire is a nanosatellite company. So satellites that are little cubes about this big, and with their, they did a couple of seed rounds, but in total raised $4 million. They were able to send 4 satellites into space and set up multiple ground stations, and then raise a $25 million Series A on the back of that. So you can see that that's a model where you get a lot done and then still need more capital to scale. And then we also have companies where they're so capital efficient that really the company may not need to raise additional capital to scale. And so one of our companies in the US is focused on something very simple in the healthcare system of just validating the transactions, where previously it used to be humans on the phone, and you can imagine both the cost and the error associated with that was pretty poor. And then they're replacing essentially 20-year-old technology, which was the best of breed. And so this company is growing 30% month on month and has a fantastic business model and is at this point growing through internal cash flow. So we like companies that can really make progress without needing to depend on significant capital to grow.
Yeah. What do you look for first and foremost, the market sector or the entrepreneur?
Definitely the entrepreneur first.
Okay.
And then going back to the geographical dynamics, I think one thing to clarify is that for us, we actually don't invest in companies in Beijing or Shanghai in the domestic Chinese market, which I think here, the seed market environment in those specific cities might be quite different from other cities. And so when we talk about valuations and trends, it's really important to really get down to the city level because each city is specific and unique. And so the trends that we typically see are what's going on in Hong Kong for global companies, and then also in Silicon Valley and other parts of the US. And yes, we're plugged into what's going on in the rest of Asia, but actually find that seed investing in Asia, you really want to be on the ground locally. And it's only in the US market where having that broader perspective is easier and more practical to do, whereas in Asia, you should live in that city to really know the market.
Okay.
Well, I guess the investment challenges we face are a little bit different. Given our fund size, we have a $10.3 billion fund, the largest ever tech PE fund in the world. We compete sometimes more with the public market, sometimes even with strategics, which have a lot of cash, and they're sometimes very eager to spend it, sometimes for tax reasons as well. What we're trying to do is to create unique alpha, so to speak. So if you look at the two of the three largest deals we've done in the recent history, other than Dell, the two deals are both acquisition financing deals. One is a company called Avago, a semiconductor company buying another huge company called LSI. Another one is a Hollywood talent agency called WME, buying a sports agency called IMG. And in these M&A transactions, it's intrinsically very difficult to create a bidding situation. I mean, no one can show up and say, let me invest in you tomorrow. By definition, M&A funding is very tricky. And in both situations, we know the buyer already extremely well because we are either current or former investors in the buyer. So we know the capability of the management team, how they can deliver synergy. So basically these are the things that no other investors in those situations can appreciate and underwrite. And these are the unique alpha that we can bring that potentially create upsized returns for our investors. But again, it's a different challenge. And we're very lucky that the companies
we back. It's a big problem to have.
Yeah, but we're very lucky that the companies we back, there are usually not 2,000 other copycats coming up, but I understand in China that happens a lot.
Sure. Are you seeing a lot more consolidation of these kind of larger tech companies that you're investing in?
Well, yeah, I think the tech world, it's not just in the U.S., in China as well. BAT, I think you see a lot of M&A activities all the time. So I think for entrepreneurs, when you create your own company, you should also keep that in mind.
Yeah.
Your relative position to the giants, and as investors, you should also look at what's hidden in a large corporation. Sometimes large corporations have internal teams that are pretty entrepreneurial. And in China, they tend to leave and create new companies. And sometimes in the US, they just stay within and create lots of value until they're so big that they want to be carved out at some point. And that creates some deal opportunities for us as well.
So yeah, that's a good point for the startups. You don't have to look at the home run IPO. You could look at the home run acquisition from a Baidu, Alibaba, Tencent, Foshan, whatever. Absolutely. Right? So that's definitely a trend going forward. Let's open it up to questions from the audience, all the way in the back. Yes. And if you wouldn't mind identifying yourself, it would be great. Thank you.
Hello.
Yeah, we hear you.
Okay, my name's David Thorne from the FS Consulting practice here in Hong Kong. at KPMG. My question's for Tina and Melissa, specifically around the fintech sector. So I'm interested to know what your sort of opinion are for the largest opportunities for disruption for the fintech sector startups in Asia.
Okay.
I think we're in Hong Kong at the center of the renminbi becoming a global currency and watching China open up to the rest of the world, and Hong Kong is actually the first stopping place. But with that comes a lot of challenges that need to get addressed. So on one side, there's a lot of boring things that need to get done. For example, KYC, know your customer, anti-money laundering, systems that have to be put in place that are very paper-oriented today. So on the most mundane side, we see a lot of opportunities, even on the operational side, to do that. When you get to the sort of cross-border trading area, a lot of the systems in place today can only handle single markets or are quite fragmented when you try to handle multi-markets. So on that side of the sort of brokerage trading, we see a lot of interesting opportunities, and Hong Kong's actually a perfect place for it because most of these guys have been doing cross-border trading a lot longer, and those are opportunities you don't see in the U.S., by the way, because the U.S. market's only 12% of trades are cross-border, where in Asia, Japan is 70%, Hong Kong's 45%. And then basically it gets back to what Jenny was saying earlier, which is the whole mobile aspect of banking. And the fact that you have, very high 126% mobile phone penetration in certain parts of Asia. You have average ages that are 27 to 29, and 66% of the world's middle class is going to be here. And guess what? They're not going to walk into a bank branch. They're not going to write checks. They're going to their transactions are going to be done in a very frictionless way on a mobile device. And so those are the areas that we're most focused on and we're most excited about. But the fact that you have to I have little baggies of yen, I have little baggies of Singapore dollars, I've got New Zealand dollars. I mean, I'm sitting in my wallet today with 7 currencies because that's where I've been over the last couple of weeks. That shouldn't be. I should pull out my mobile phone and I should be able to pay for it in whatever currency I want. So, yeah. So I think Bitcoin as a payment infrastructure. But those are some of the opportunities, and it's pretty exciting. And I don't think you'll see that level of excitement in the U.S. markets, quite frankly. I think Asia is absolutely the place to be to see fintech innovation going forward.
Yeah, I totally agree. I think fintech has tremendous amount of opportunities that will create dozens and dozens billion-dollar companies. That's my prediction going forward. Part of the reason is if you think about the digitalization, the whole trend is disintermediate the entire banking industry. The role of the banks will change in the next 5 to 10 years. Their role will be very much diminished if they don't play the innovation game. I think the startups will kick the butt of the traditional financial institutions. We're making inroads in everything from lending, right, peer-to-peer lending, from payments, from banking, traditional banking, making loans to small business, and last thing, wealth management. So Credit East, for example, is now venturing to 10 different business units. We're not just peer-to-peer lending. We're now leaders in auto loans, short-term auto loans. You walk in, we give you a GPS device, we give you a 6-month loan, very favorable rate, as long as we know where your car is. We're now the leader in venture lending for small business. So basically, not just Credit East, there are lots and lots of different kind of innovations that are happening in the fintech space. With the additions of mobile internet, you can just imagine if you have the knowledge base at your fingertips, you can basically get professional advice on how to make investments, which everyone already have, but it's not just information about stock quotes, but it's really people says, hey, this is a great product, this is happening, this is a trend, you have 5 minutes or 5 hours to subscribe. That's gonna happen very quickly. So it's just that you can walk around and still make money. You can do lots of financial services transactions, everything at your fingertips. That's the future in our view.
Very exciting. Yes. Well,
Rebecca, we have a gentleman here.
The last row. in the
Thanks
middle,
very
yes.
much, Rebecca. Thanks for another great lineup. It's a real pleasure to be here. I've got a question for the panel, general question about the Internet of Things. We're a Hong Kong company who last night won the Las Vegas hackathon for Internet of Things, which is sponsored by Amazon and Intel, but we're based here. We have a strategic problem which is related to what you were talking about, all of you, from an investment perspective. Given the very large but antiquated manufacturing base in China, do you think that there's a bigger investment opportunity to be made here in Asia for Internet of Things rather than through the US? What's
Okay.
your strategy for that?
One person, please, answer so we can stay on schedule.
I can talk about that. So when we look at Internet of Things, we look at it from a global perspective. If you have a product that's made, designed in, say, in Hong Kong or in Singapore, in China, I think the key is understanding where is the first market. Your first market to buy this product may be in the US. And so from that perspective, the IoT space is a global space. For example, we invested in a company that does golf sensors. So if you play golf, baseball, or tennis, you can now have a sensor that captures your swing real-time on an app when you're to try and improve that game. So this company is actually a Chinese company designed and developed by a Chinese founder. But when they sold this product, they sold the product first featured on the Apple Store in the US. Because naturally, you know, that's a very targeted market to think about. And so they recruited a co-founder in the US who's recently from Apple and Jawbone, who actually understands how to do retailing in the US market. So in that sense, you may think of it as, is it a Chinese company or US company? But in reality, it's a global company. So understanding and leveraging the world resources in this space is actually absolutely important. It doesn't matter where your DNA is, whether you're Indonesian or Malaysian, but I think it's important to know ultimately where that product can get its first customer, because this is a brand new space. So having that product be endorsed in the right manner and then have that user experience develop. But think about then the company can come back to China and equip badminton and table tennis and the likes, right? The Chinese sports. So that's how I would advise you guys to think about that.
Well, great. Thank you. Wonderful panel. A lot of learning here. Okay, thanks so much.